We've all seen TikTok tax strategies being promoted widely as amazing, highly beneficial, but today we're going to plot them in terms of hassle versus tax savings. So on the left-hand side of this chart that I've created, I've got hassle low to high, and then on the bottom, I've got tax savings low to high. Ideally, we land in that bottom right-hand quadrant, right? Because that's high tax savings and low hassle. We don't want to jump through a ton of hoops to get tax savings. Otherwise, the return on our time is minuscule. So let's see where the top 5 TikTok tax strategies end up falling on this chart. And before we jump into it, I am a CPA. I provide tax advice to high-income individuals, business owners, and real estate investors. If you want to learn more or jump on our newsletter, hit the link in the bio. So we're going to start with my favorite one, and it's also the most egregious in my opinion, and that is using an LLC to write off your life. So I'm going to put this way over here. High hassle and very low savings, because setting up an LLC in and of itself does not give you business tax deductions. Business expense is tax deductible as long as it is ordinary and necessary, and setting up an LLC and running an expense through an LLC is not going to make a business expense tax deductible. It would be deductible with or without that LLC. So when you see influencers say, I set up an LLC and now I'm writing off my haircut and my clothing, they're full of junk. The next one we're going to hit is the Augusta rule. So let's move that one. We're going to put that one right about there. Now, the Augusta rule, when run properly, can result in higher tax savings than what I've displayed here. However, most people don't run this strategy correctly, and it is high hassle regardless of how effective you run. So the Augusta rule works like this. Your business rents your personal home from you for 14 days or less. The business gets a tax deduction for the rents that it pays you, but you don't have to report the rental income because you rented your primary residence for 14 days or less. Now, this works because the business might need meeting space, might need board meetings, whatever. But to justify it, you have to have stellar documentation. And part of that documentation is an appraisal of what the nightly room or the daily room rental rates should actually be. Most people mess this up and lose in an IRS audit. So this is super high hassle, mainly because of that risk factor running the Augusta rule and low savings compared to other options. All right, the next one is a TikTok favorite. This is paying our kids, and I'm gonna land that one right there. So paying our kids is super high hassle, and very few influencers talk about all of the things that go into having to pay your kids. It's also high risk under any sort of IRS audit, and often will get nitpicked. So your documentation has to be stellar. Now, the tax savings on paying your kids actually isn't that high. You could run the strategy every single year, and you could max out this strategy and drive the tax savings higher. But most of us that have kids aren't going to be able to actually max the strategy out because our kids don't have the capability to work real jobs quite yet in their lives. They're just not old enough. So if you're paying your kids for modeling, or if you're paying your 6-year-old to do landscaping at your business property or whatever, you are totally at risk of losing under an IRS audit here. And that's why I've got this thing at a high hassle. If you are paying your kids, you have to have an actual job description. You have to actually pay them like you would any other W-2 employee. You have to file payroll tax returns. And if you miss any of that, you will lose under an IRS audit and everything will be reversed. So that's why I have paying your kids as high hassle, low savings. If you run this correctly, you could bring the hassle down a little bit and the risk down a little bit and move the tax savings to the right. But most people do not do this correctly. All right, the next one we're going to run is the G-Wagon tax deduction. That's a favorite of mine as well. We do have higher tax savings on a G-Wagon tax deduction, or any business vehicle for that matter. And we have higher tax savings because if you do this correctly, you can immediately deduct the full purchase price of a business vehicle. But I've got it at high hassle because you can only deduct up to the amount of business use. So if you use your G-Wagon or similar SUV for business only 60% of the time, then you can only deduct 60% of the purchase price, not 100%. You also have to track every single trip, personal and business trips that you make in this vehicle. That's why it's high hassle. And the last one, which is my favorite, the STR loophole, we're going to place right there. Really high tax savings, medium hassle. Maybe it's a little bit higher hassle based on personal preference. You do have to self-manage a property or an Airbnb rental to run this effectively and safely. So if running an Airbnb is very hard or difficult or sounds challenging to you, then we can just go ahead and move this short-term rental loophole up in terms of the hassle threshold. But super high tax savings if you can run this effectively. You get a cost segregation study performed. It gives you bonus depreciation. That bonus depreciation will create a tax loss most of the time, and that tax loss can then be used to offset your W-2 income or your business income, assuming that you do materially participate in the short-term rental. And that is the thing that everybody messes up, which is why I've got it at medium to high hassle. If you mess up material participation and if you are audited, that tax loss that you're able to claim will be reversed. You'll owe penalties and interest on it. That is certainly not an area that you want to mess with, so make sure that you've got a good CPA on your team.